A survey of 2,500 companies revealed a massive gap. For every dollar spent on AI, only 18 cents reaches a final product. The rest is lost to fixing the errors the AI creates. Yet the capital continues to flow. In June 2026, the Bank of International Settlements issued a warning that AI spending and circular financing have reached a scale that poses a systemic risk to the global economy. Between 2020 and 2025, the 6 largest tech giants doubled to $20 trillion. Today, it's over $23 trillion. This growth is the economy's primary engine. Analysis shows 92% of recent US GDP growth came from just 2 categories: information processing systems and software. But forensic accountants have noted a discrepancy in the books of the major hyperscalers. When you subtract the capital expenditure on new data centers and the cost of stock buybacks, the actual free cash flow of these companies is declining. When national growth figures are heavily weighted toward hardware spending by companies with falling cash flow, the standard indicators of a healthy economy become significantly less reliable. To maintain these valuations despite the cash bleed, companies have increasingly relied on a strategy called circular financing. The relationship between Google and Anthropic serves as a clear case study of how this loop operates. Google maintains a multi-billion-dollar stake in the company, while also acting as its primary infrastructure provider. In early 2026, Google reported a $28 billion jump in profits. They recorded this massive spike under the vague heading of other income on their balance sheets. The mechanism is straightforward. Google provides Anthropic with a $10 billion investment. Anthropic then uses that capital to sign a contract for Google's cloud servers. This allows Google to book those billions as revenue and profit immediately. Google then reinvests that recorded profit back into Anthropic at an even higher valuation, allowing the cycle to repeat without requiring any external demand for an actual product. This loop creates the appearance of massive growth on a balance sheet, inflating valuations through internal capital movement rather than value creation. These deals are often obscured through third parties. In May 2026, market analyst Michael Burry identified a complex web of transactions involving Nvidia's hardware sales. Nvidia reported over $5 billion in GPU sales during that period, but the buyers weren't the traditional tech companies using the chips. The hardware was sold to a shell company called Valor. Valor then leased those chips to Elon Musk's AI. This allowed Nvidia to book the sales revenue, while AI gained the processing power for its models. The capital for this operation originated from an insurance entity called Athene, which manages the pension funds of everyday retirees. In this system, billionaires generate liquidity for their investors by shifting the long-term financial risk of this hardware onto public retirement funds. While the financing stays high, the real-world performance of AI has been inconsistent. Starbucks recently abandoned an AI inventory tool after it failed across 41,000 locations, requiring staff to manually correct the AI's errors. Duolingo's attempt to replace human staff with AI resulted in such poor quality that the company was forced to reverse its strategy. Even AI leaders are shifting their tone. Sam Altman, who once forecasted widespread job displacement, now suggests the impact may be far more limited. Many major corporations are now pivoting away from expensive American AI models. Companies like Microsoft and Uber Eats are increasingly adopting cheaper, open-source models from China to reduce costs and maintain data control. As the hype reaches a peak, companies outside the software sector are relabeling themselves to secure a portion of the AI capital. SpaceX recently filed its IPO under data processing rather than aerospace, claiming the vast majority of its market share is now AI-driven. Regulatory bodies like the SEC have yet to intervene, as these circular financing deals are currently within the bounds of the law. The current AI boom relies more on financial engineering than a technological breakthrough. It is a system built on shifting risks and internal capital loops, and the question remains, who will pay the cost when the mirage fades?